Arvind Sanger is now joining us, Managing Partner, Geosphere Capital Management. And it's a good day to have you with us, Arvind. You've been, from what I remember at least, I don't know if you changed your view in between. It's been a while since we spoke, so good to speak to you again. You've been pretty clear that this is not a problem which is going to go away quickly, and it will take a toll on markets. I mean, the rally here has been absolutely stunning, isn't it? It puts us right at number one pole position in terms of rankings for the year, return-wise. What does this inflation number do for prospects here in India specifically, in your opinion?
Well, I mean, we have to also look at inflation in India, right? So the global sell-off and the dollar strength is going to drive some outflows out of India as well, out of other, emerging markets and risk assets. So that, is coming. But the reason India has been, a relative outperformer amongst most major emerging markets and most major global markets is because the underpinnings of growth have been better. Inflation has been somewhat more muted compared to what it is, in many developed countries in the West. So, the inflation data that came out from India was slightly above expectations, 7% versus 6.9 expectations. I think the real question, again, for all global economies is what is the trajectory of inflation and what is the trajectory of growth? And if the inflation in India can remain on a downward path, which it hasn't clearly demonstrated that it is, and RBI doesn't have to slam on the brakes as hard as we are seeing Fed having to slam on the brakes, then India can continue to be an outperformer. But the real challenge is going to be if Indian inflation stays stickily high, then RBI cannot afford to be dovish and let inflation expectation get unanchored. So, in a sense, my view is that India has better growth trajectory, but the inflation trajectory, I am less clear on where India is going. I've been much more, cautious on inflation magically not disappearing. That's been my view. In the West, India, I'm a little less certain now.
Arvind, good morning and thanks for being with us. It's been a smooth ride, right, for the Indian markets. I mean, it's a 15% rally that we've seen in the last 3 months alone. And as you said, not just inflation, which has been under control up until now, but corporate profitability is also improving. The profit to GDP ratio is now at a decadal high. Would you buy the dip, even if there is a dip through the course of the next couple of weeks? Should the dips continue to be bought in a market like India?
I think so, provided that there is no significant deterioration in global fundamentals. India is in a sweet spot. It has the benefit from all the resourcing or friendshoring or whatever term that is driving growth. India itself has a resilience after having had multiple years of different headwinds. So Indian economy, I think, is in a good shape. And so, yes, the earnings are reflective of that. And that's one thing that I've been very clear about. Indian economic growth and Indian earnings growth is probably one of the brighter spots in the world. And so I think that, yes, so we are more inclined to look at dips as a buying opportunity than panicking here. Although, we have to watch the currency, but I do believe that if Indian inflation, I can't remember the last time you had persistent 3-4 months of Indian inflation running below U.S. inflation. I mean, that's almost unheard of. So I think we have some tailwinds which provide, even on the currency front, some support that this is not going to be, from this $80, $79, $80 level. There's not a huge downside if the inflation differentials stay in India's favor, which again is almost unheard of.
Morning, Arvind. Two-part question, Arvind. Are you in the camp that believes that the Fed will do more than 75 basis points, maybe 100 basis points? Do you believe that? And the second fact is, do you believe that the June 2022 lows, they will hold out? The global markets have made lows for, for the year at least.
On the first one, I have a more clear picture, and I would say that I think it's unlikely the Fed is going to panic and suddenly go to 100 basis points. I think inflation, is coming down. It's coming down slower than they would have hoped. But I think they may do, 2 or 3 75s rather than do 100. So my bet is on 75. But, we'll find out soon enough. But my bet would be 75. I'm sorry, can you repeat the other question?
Have the lows for global equities that we saw June 2022, is that likely to hold out? Or do you believe we could revisit that at some point of time if the Fed is very hawkish, growth slows down? Your take.
Yeah, I think that's a trickier one. That's a trickier one because it depends on how hard they have to slam on the brakes. And, if they have to slam on the brakes repeatedly hard and the economy is going to go into a, recession, earnings are, going to come down sharply and it's going to be 2 or 3 quarters of earnings weakness, then it's very hard to say that the market could have discarded all that in June. And therefore, that's the trickier one, in my opinion. It's kind of data dependent. It's how much they have to do, how persistent the inflation is going to remain. And, let's keep in mind, for the U.S., for the rest of the world, one of the big positives on the inflation front is China's zero COVID strategy and its slowdown, which has helped moderate inflation in the rest of the world. Because if China was going, commodity prices would not be as benign as they are, and that would add fuel to the fire. So let's take a case why this could turn out worse. If China, after President Xi gets his next 5-year term, starts reaccelerating, does that cause inflation globally to perk up, and that requires more of a slamming on the brakes? So that's why there are too many factors that are unknown to be able to say that June was definitely the low. So we'll watch the data and try to be a little more careful on that, getting too convinced one way or the other.
Arvind, companies that we speak with here locally, there's a general feeling of optimism about, earnings growth sustaining, even picking up. Except maybe, entry-level segments across sectors doing a little poorly. But overall, it's more optimism than anything else. Investors that we speak with who are meeting companies, just the overall feedback is quite positive. Do you think the flows that we're seeing, these foreign flows, chunky amounts every day now, this is backing some of that? Or do you think this is, if you've heard anything of that sort, some sort of specific allocation for India because of all of the outflows we've seen, which were because of emerging markets as an asset class suffering? So this is some dedicated inflow for a market like India. What's happening in your opinion?
Well, there are two different factors at play. One is risk-on, and the other is India relative. On the risk-on front, you've had risk-on for the last couple of months, and that has meant money getting allocated to emerging markets. And in terms of relative on emerging markets, India is clearly one of the best positioned. You have Brazil with an election with a lot of uncertainty, how the acceptance of that election results will go. You have Russia, which is uninvestable. You have China, which has made itself uninvestable. So you have, major emerging markets which are under a cloud, and India is one of the few bright spots where earnings growth has got some legs, and you don't have, some of the other risks around politics and around geopolitics. Therefore, yes, India will remain a bastion, in my opinion, of attracting foreign capital. I think, you may see a temporary outflow because of risk-off, because of what, is going on with inflation and what the Fed might be forced to do. But I wouldn't worry too much about it. This is not like what it was in 6 months ago, where there was continuous outflows, India and other emerging markets. I think that shock is largely behind us, but there will be ebbs and flows. But I think India will be a relative winner.
Okay, just one final question. We've been seeing this market be led by financials right up until now. IT has not done too well. In fact, most of these large cap IT stocks are under a lot of pressure. But now there's a narrative that perhaps the worst of the margin pressures is behind these IT companies. In fact, TCS mentioned that at a recent analyst meet as well. Is this a time to load up on IT?
Well, I think IT has had two headwinds. Obviously, one is the margins were unusually good when there was no travel and a lot of other stuff that helped margins. So there's been a little bit of a margin pullback. Wage pressures, are probably rising, as well as staff attrition. But I think the other question is how much of a recession, if the West has, certainly the U.S., which is the most important market for IT companies in India, how much will that affect? So I'm not sure that IT is the best place, because at the end of the day, IT has an angle of Western growth and economic sensitivity at some end thrown in. So I think IT stocks have gotten cheap, but let's be a little more cautious about how much does the U.S. economy slow down. That's the only remaining headwind. The other headwinds, I think, are largely discounted in the IT stocks.